How much Bitcoin is enough? Today I'm going to be reacting to Tech Lead, who's another guy I think is very interesting to follow in this whole where is this tech stuff taking us? He's an ex-engineer, Google engineer, and his takes are usually pretty funny and aligned with stuff I think. But sometimes, of course, he has different opinions than me. So this is a very interesting question about Bitcoin because I know a lot of people ask me because my app Stacker.ai helps people buy more Bitcoin. How much do I need? So it's always interesting to have other people's ideas about this. So let's see what Tech Lead thinks and let's see what I think.
So how much Bitcoin should we hold anyways? What's the proper So how much Bitcoin should we hold anyways? What's the proper allocation? And my view is it's no longer about if you own Bitcoin, it's how much of it you have. Because I think by today, many people have small amounts of Bitcoin here and there. And, if the price were to double or even to go up 10x, well, if you only have like say a 1% allocation, well maybe now you have a 2% allocation or a 10% allocation, and it's not going to really change your life by much. And so it's not sufficient to just be right, but you have to have the conviction to double down when you have a winning hand in a generational play. You may not get dealt such a winning hand again. For example, in blackjack, if you get a winning hand, you got to double down or you lose your edge. And the fact is, at the end of the day, when all of this crypto stuff is done, and the wild frontier is long gone in the past, and you have had all these crazy stories about what it was like to have lived through this era. The one question your grandkids will ask you is, did you get the Bitcoin? Did you get it? How much Bitcoin did you actually get? How much of it do you have? And you're going to say, well, you got Cardano, you got Ethereum or Solana. Ethereum's kind of like Bitcoin, isn't it? You got some Apple stock, you realize some gains into an Airbnb for passive income, and that your true allocation to Bitcoin was just like 1% or half a percent.
That's very interesting. I just created a video about that same example. You know, we're in this like time where new money may have just been created, new gold, new asset class. What do you do? What do you do? And 5 years ago now, I did the safe play. I bought the Airbnb passive income thing. And I realized that mistake and I sold my property last year to put into Bitcoin and Ethereum. Because again, I believe Bitcoin and Ethereum are close. Not saying I don't know which one is going to be bigger. He seems to think Bitcoin is going to be bigger because it says how much Bitcoin. But what he's saying is valid. Like, where are you going to put your money to keep the value of it, as much of it as possible to pass on to your grandkids?
At the time when there was a generational birth of a new asset class that you lived through. And what you did was get yourself confused and bought everything except for Bitcoin. Or maybe you bought a bit and thought that would be enough. But the fact is, nobody has enough. Now, if we take a look at what BlackRock says in the traditional portfolio, 60/40 stocks and bonds, they say maybe a 1 to 2% allocation to Bitcoin seems a reasonable range for Bitcoin exposure. Now, this is interesting because just 2 years ago, there was another report from BlackRock which stated the optimal BTC allocation is about 84.9%. So, anywhere from 2% to 85% of your portfolio.
This guy's funny. You can't really tell if he's being like if he's saying a joke or he's right. But that's a crazy range, right? At the end of the day, 85% to two, that's like ridiculous. But if BlackRock just puts 2% of all their clients' money, Bitcoin goes to like hundreds of thousands of dollars. So this is where, again, as I create this video, it's about 100. When I first started creating videos, it was about 5,000. So in 5 years, it went from 5,000 to 100,000. Not to say it keeps that same trajectory. Let's say it slows down slowly over time, but so did the stock market. The stock market hasn't settled into 7 to 12% per year in growth till 100 years after it was created, right? So what happens with Bitcoin? If it takes 100 years, Bitcoin and Ethereum, if it takes 100 years to get to 7 to 12%, just like the stock market, that's cool with me. I'll be stacking as much of it as possible till then. and I'll probably be dead. My my great grandkids will be benefiting from all the Bitcoin and Ethereum I got.
Portfolio. And of course, the Bitcoin maximalist will say 100%. And, there's also some people who will say, well, maybe Ethereum, right? 50-50 ETH BTC. The problem with that, though, is like, let's say Ethereum goes to zero and Bitcoin doubles in price. Well, then you would have just broken even and made nothing. And if you had diversified even more into a random basket of stocks like Solana, Cardano, Ripple, you could even find yourself losing money, all the while Bitcoin could still be going up in price.
So this is a kind of a Bitcoin maximalist take, right? Because decentralized finance is being run on Ethereum. And if decentralized finance is going to be a thing, Ethereum is going to be a thing. Because you really can't do much with Bitcoin. You can hold it and spend it. And if you believe Bitcoin is going up in value, why would you spend it? You might as well borrow off of it instead of spending it, right? Borrow tax free versus spending it, you pay taxes. Once people understand that and they want to do it, they can't do it unless they give their Bitcoin to some centralized entity and get cash back. If you want to do it in a decentralized way, you do it on Ethereum. So this is where I don't see eye to eye with these Bitcoin maximalists. If you if decentralized finance is a thing, Ethereum is a thing, in my opinion.
So let's get down to the bottom of this. Today, I will give you my thoughts on the proper allocation of Bitcoin and the state of crypto in 2025. Now, in order to understand proper Bitcoin allocation, it begins with understanding why your current investments and holdings are so risky. If you don't believe in Bitcoin, you're probably storing your wealth in something else, right? Like tech stocks or US equities. And in my last video, The State of Tech 2025, I addressed why you should sell all of your tech stocks and the S&P 500. Fact is, a lot of these tech stocks have just run up too much that they're having difficulty justifying their valuations and are now reaching into ridiculous fantasies like AGI, quantum computing, nuclear reactors, and the bill for all of this is coming in, and you're going to be on the hook for all of this stuff if you're holding onto any of these tech stocks. Didn't Warren Buffett even sell a bunch of his stocks? In 2024, he sold $130 billion worth of stocks and is a net seller of equities. So Warren Buffett is even getting out. He's stockpiling.
Yeah, so this is this is like what again, why as entrepreneurs you gotta understand investment because this could affect a lot, right? So what he's talking about is definitely something that you see a lot of. The CEOs are selling their stocks. Warren Buffett is selling a lot. He's selling more than he's buying. That usually tells you that they see something coming. A lot of times they create the thing that's coming by doing this, and other stuff. But yeah, so tech stocks right now, they're saying they're like they're like value is so over like inflated like by 20x of the value of the company because the value of the company is based on the revenue times whatever the industry is. But if you're able to multiply the revenue by let's say you're in an industry that takes a 10x multiple and the business does $500 million a year, 10x mobile I mean multiple puts you at whatever, the stock is worth 20 times more than that. So what they're saying is everything is so highly inflated that it has to be a correction sometime.
Cash, he cut his stake in Apple by over 50%. So stocks aren't really safe at all. Well, what about real estate? A lot of people historically in the baby boomer generation stored their wealth in houses, except today the game's changed. Now we have fires in LA, California, we have the Lahaina fires in Hawaii, there's hurricanes in Florida. And the thing is, a lot of these homes aren't insured. Home insurance costs and HOAs are skyrocketing nowadays throughout the country as homeowners are being tapped as the last source of wealth for a broke country. If you're a homeowner, you are the buyer of last resort. You absorb all of the inflation and debt of a nation by forcible payments of maintenance, HOAs, contractors, insurance supplies, materials, taxes, and eventually you lose the very house itself. When other people need money, they come to you, the homeowner, because you're their piggy bank and you have to pay for maintenance, services, taxes, repairs. You've got
I just dealt with this. I had a beachfront property, sold it. Very similar. I rented it Airbnb. It was making, a good amount, nothing crazy. It was covering itself and a little bit more. The city flooded multiple times because of not even because of global warming stuff, but because of just local bad construction. The pool got messed up, so we all had to pay like $1,000 extra, which the property didn't even make. It made like 300 profit every month. So $1,000 thing takes 3 months of my profit, and that's just one thing. This it flooded multiple times. I had to re buy all the furniture multiple times. Real estate is not what people make it out to be. Again, some people do it well. I feel like it only works if you have scale. If you got 5, 10 properties and you have a property manager. That's the only way I can see it really working, but that is most things. Businesses as well. When you hear franchisees and stuff like that, same thing. You buy one franchise and you're in a similar boat that I was in with the real estate. You're not making that much. It's kind of like having a job. But if you got 10 franchises and you got somebody managing it, then you're making good money. That's where like the Shacks of the world. You hear Shaq, I bought 55 guys. That's how, because again, he has a manager managing 50 of them. And let's say he's making 40K a year off each one. That's good for Shaq because it's times 50. But if it's just you and you're making 40K off one, that's a 40K job then, right? So this is where like real estate, I personally don't think real estate is the way to go. I think it was our past generations way of making money. You bought a property for 100 grand and now it's worth 1.8 million. Yeah. But if you're buying a property right now for 1.8 million, is it going to be worth 10 million when in your lifetime? I don't think so.
embezzlement, extortion, kickbacks are everywhere. Soaring insurance costs are hurting sales. And every time you need a repair, something breaks and you need a contractor, they come by and the first thing they do is they take a look at your house and say, hey, that seems like a pretty nice house, seems kind of expensive. And they'll quote you some crazy price they pick out of the air that's 10 times the price of the next quote. Homeownership is scam city. And if you take a look at the return on investment of many of these homes, a lot of prices don't move much. They go up 1 or 2% a year. But after maintenance and property taxes, you're just breaking even and your return on investment is basically zero. The truth about these homeowners is they're all actually sidelined on Bitcoin in an illiquid housing market.
That's another thing. Once I decided I wanted to sell it, it took me over 8 months to sell it. And I was lucky because if I didn't sell it when I did, it flooded the week after I sold it. I would have had to pay again for everything. So, man, real estate is tough. And this could have just been my unlucky. But again, research heavily all asset classes. I think that is a very, very important thing to do because you have to figure out you're making money. As you're making money right now and you're able to make money, you have the right career, hopefully, right business, you're making money. Where does it go to keep as much of it as possible? This is why I created Stack.
Ever since interest rates shot up, the housing market froze, actually, and anyone who had capital is now locked in. They're sidelined, waiting, and they cannot free up the liquidity. Everyone is sidelined. And the fact is, these homeowners could not buy Bitcoin even if they wanted to.
So one thing that is possible is they could borrow off of their houses, right? They could take a home equity loan, right? And buy Bitcoin or do something else with it, right? And that is possible, but again, it's only possible if you get the bank to agree. So you have to go in. So I got friends that are retired, like that were millionaires when they retired, and now they're running out of money, right? So you live a certain amount of time without making money and you're not investing it, you're gonna run out. So now they go into their properties and they're like, okay, I just borrowed from my property, right? Well, the bank is like, well, you don't make money, so you're not gonna be able to pay us back our loan. So no, you can't get a loan on your properties. You have to sell them. And that is this is another great way that decentralized finance is amazing. Because if you have the same situation in decentralized finance, there's nobody to tell you you can't pay the loan back. You can take out whatever loan you want. If you can't pay it back, they're just gonna take some of your collateral assets to pay it off. And with Stack, we protect that. No liquidations. Check out the description. Like, subscribe, follow for more.
They're waiting for the housing market to thaw before they can actually get in. And so, as we see the birth of this new digital assets industry, the overarching narrative is going to be a flow from the TradFi world into the digital world over the next decade. And just on the macro level, there's $900 trillion of wealth in the economy, and Bitcoin is just at $1 trillion. So, this begins with understanding the stores of wealth you currently hold are not all that great. Now, looking at crypto, a lot of people just buy a basket of cryptocurrencies like Ethereum. And the problem is this just may dilute your exposure to Bitcoin. The problem with Ethereum is it may actually go to zero, as all activity and liquidity could drain out to the L2s like Base or Arbitrum. Layer 2s are now handling 5 times the transaction volume of Ethereum mainnet, with 10 million active addresses compared to just 2 million on mainnet. See, because an L2 will always have lower gas fees, it will always have higher transactions, higher volume, and therefore higher yield. And so it doesn't make sense to provide liquidity on Ethereum mainnet. And it's only a matter of time before the TVL, total value locked on mainnet, goes to zero. The end state of Ethereum may be that it will be nothing more than a bare bones shell for L2s to write data back onto. In addition, making matters worse for Ethereum, wallets are also now completely eliminating gas fees. So, for example, Coinbase Smart Wallet does not require gas fees anymore for you to send receive USDC stablecoins. They're just sponsoring that stuff, deeming Ethereum and gas fees too complicated for the mainstream masses. And in other cases, like with Rabby Wallet, you have automatic conversion to pay for gas fees with stablecoins now. And so eventually, Ethereum will be completely abstracted away, probably even by the end of this year, and nobody will know what Ethereum even is anymore. Well, what about Solana?
So I don't agree with that at all. So what he's not saying is the way all those layer twos exist is on top of Ethereum. So he is right where it's not going to make sense to keep money on Ethereum for most people. For the richest people in the world, yes, it will, because that is the safest way to do it. But it's just so expensive that it doesn't make sense for a person with 1,000, 5,000, 10,000 to have their money on Ethereum. If you got millions, it does. Billions, it does. But layer two is like the way it works is kind of like a an amusement park, right? So to get in the amusement park, you need to pay for a ticket. So what's happening right now is to get into the Ethereum amusement park, it costs a lot. Let's say it costs $100 to get into the park. Some people go right now, some people go that can't afford it. Most people can't afford it. So they're creating these mini parks. But to get into the park, you don't need to pay the $100. 100 of you can pay $1. So that's what's happening. These L2s are still paying the Ethereum ticket. There's just more of those people paying that ticket. So Ethereum will still do what it's meant to do. This whole concept was created by the creator of Ethereum to scale Ethereum. He planned on this. So I don't think this is again like a Bitcoin maximalist thought where Ethereum needs to have money on its chain and people need to use that chain for the value of it to go up. The way Ethereum works is every time Ethereum is used, some Ethereum is burned away, meaning the more it's used, the less of it exists. So what happens when less of something that a lot of people need to use is around, it goes up in price. At least that's what I think. Not financial advice. Any of this is not financial advice. But from what I see is I deal with mega rich people with a lot of Bitcoin. And then they use my app Stack because they can't do what we can do anywhere else. But I tell them, you know, this is only possible because Ethereum exists. And it will only be possible as long as Ethereum exists. So, in a way, Ethereum is as connected to Bitcoin as anything else. It's kind of like a marriage made in heaven. Because again, you can't do anything with Bitcoin. You're going to need decentralized finance applications built around what Bitcoin represents. Where are those going to be built? Ethereum, Solana, he's about to speak about, which I also liked Solana, but the more I went in there as a developer and a business person, I realized it wasn't going to be able to do what I needed it to do to build Stack. So I built on Ethereum, and most of other people are doing the same.
You may be asking. Give you my thoughts on that. Solana has been mostly sustained by meme coins and pump fund, which has all been hilarious over the past year, but it's clear that, at least for now, the industry has chosen EVM, Ethereum Virtual Machine, as the standard. And I believe this is going to be the main narrative of 2025, where it is going to be built on the Optimism superchain. On chain is the new internet, and the wallet is the new browser. So building on Optimism superchain, we have Coinbase, Kraken, Uniswap, and Sony, all building on-chain ecosystems for 2025. And if successful, this could become the internet of global finance, digital assets, gaming, art, identity, and ownership. These are L2 blockchains, interoperable yet independent, and there's expected to be hundreds or even thousands of these L2 blockchains. Coinbase is building Base, which is seeing rapid growth, growing to be their own internet and ecosystem. We're talking commerce, gaming, art, assets on a global level. It's essentially a second internet and arguably the most important layer of finance and digital ownership. Kraken is also now doing the same, building the Ink blockchain on the Optimism superchain. And then you have Uniswap and Sony also carving out their piece of the pie. Uniswap may be taking all of their liquidity with them onto the Unichain. And so that's why I think all of the liquidity and activity will drain out of Ethereum mainnet into these side chains, which are forming the new global on-chain internet. Optimism.
But again, all of those chains need to pay the ticket to get into the park. So every single usage, every single time all those chains do anything, they are going to buy Ethereum and burn Ethereum. So, Tech Lead, I think you're wrong.
Superchain, in their own words, is building the user-owned internet. And already,
look what it says right there. Optimism is Ethereum.
50% of all L2 transactions are on the superchain ecosystem. And so this next layer of the internet is already taking shape. And Solana, being incompatible with EVM, may be too isolated on its own. And we may see these standalone blockchains just not able to compete with the corporate funded blockchains, like with Coinbase or Kraken behind them, funding ecosystems, performant blockchains, sponsoring gas fees, or continued wallet UI development. I'm actually surprised more companies are still sleeping on this because they risk being left behind. And you may be wondering, why do we need so many L2 blockchains? Was for the best user experience, the best performance, and ecosystem lock-in, as every company is carving out their piece of the global digital asset internet pie. The way to think about this is a complete on-chain experience requires two components. It's the blockchain and the wallet. The blockchain is the backend. It's how you guarantee uptime and performance for your users. So for example, a company like Google may hesitate to build services on Solana blockchain where they don't control the performance or uptime and it could be going down randomly every so often and users are just getting frustrated. No, companies want their own control and to guarantee minimum uptime and performance requirements. And then the wallet is the UI. The wallet is as important as the browser is to the internet. It is table stakes, and I think every major company needs to consider building their own wallet if they want a piece of the on-chain pie. So in the end, though, the question boils down to, did you get yourself lost and how much Bitcoin did you actually get? And you may find what you did was just get yourself confused and bought everything except for Bitcoin. So here's the scary thing about how Bitcoin works. The amount of Bitcoin you can buy today is probably the most you will ever have in your life as the price keeps going up. Even if the price were to double, the amount of Bitcoins that you have will not change. 1 BTC equals 1 BTC. And if you were to spend it, basically you just lose it forever, generationally, as Bitcoin becomes harder and harder to acquire. And the only way to truly acquire more Bitcoin would be through leverage. The problem with leverage is due to its high volatility, you would be wiped out. But
This is where Stack comes in. The truth of why I created Stack is just what he said. You want to buy more. Just like a house, right? When you want to buy a house, you can't afford the full house. So you need to put a down payment on it and then you pay it off over time and you buy that house over 30 years. So with Stack, what I thought through was what if people could put in less money and own more Bitcoin and Ethereum? How would I do that? So what I did was I created a decentralized application on an EVM Polygon because it was a lower gas fees. And when I built this, it had the highest liquidity on a smaller gas fee. And what we do is you deposit the money, your cash, you borrow right away. So let's say you bring in 10,000, borrow 8,000. Now that 10,000 will get invested into Bitcoin and Ethereum. So you just invested 10,000 of Bitcoin and Ethereum with only 2,000. That's leverage, right? So you basically took 2,000, kept it in the system, borrowed 8. The 10 is going to turn into Bitcoin and Ethereum for you over time. We dollar cost average. We don't buy it right away because that helps us with the volatility. So what's that? Leverage, right? You basically bought 10K worth of Bitcoin and Ethereum with 2K. That's what I thought about too. Exactly what he's saying. I want to buy as much of it as I can right now through leverage. But what we do, what he is probably going to bring up is liquidations. If the price falls, you get liquidated. We protect liquidations by selling some, as little as possible of your Bitcoin and Ethereum to protect the loan. So you can watch other videos on that. I'll link to some below.
the proper allocation, if you could take out leverage, I would say would be closer to 5x, 500%.
5x. That's exactly what I just said. 20%, right? So you put in 10K, borrow 8,000, that's 2,000, that's 5 times exact.
That's right.
Maybe I need to talk to Tech Lead about sponsoring Stack.
And the reasoning for this is if you view Bitcoin as real estate, as good of a store of value as real estate, you know,
That's real estate. How do you buy real estate?
people take out mortgages to buy real estate and they go on heavy leverage on that, like a 30-year mortgage to buy their homes. And so if you were to normalize a 30-year mortgage on Bitcoin, trading it as the same asset class as real estate, well, a 30-year mortgage paid at 25% of your salary, right? That's a pretty standard metric to put 25% of your income into housing. That comes out to about 7x your salary would be a proper allocation. And then in net worth terms, assuming a standard person has 6 to 12 months of emergency savings, it comes out to about 4 to 7x leverage that is normal. And so you will come out to about 5x or 500% portfolio allocation to reasonably match the performance of a real estate mortgage with Bitcoin. See, the real reason that real estate tends to outperform is because of leverage, not because housing prices go up a bit. That's what's created so much wealth for the baby boomers generation. And so it's not if you own Bitcoin, but it's about how much of it you own. That's the real play. And so this is a quantity game. The problem being that leverage on Bitcoin is so difficult to get because of volatility. Overall, though, I would say 1x leverage, that's a 100% portfolio allocation to Bitcoin, might be reasonable.
You do the amount of leverage you want on Stack. Basically, you could do, like you said, 1x, 2x, whatever you want to do. The real idea though is the overall idea around Stack is deposit invest as much as you spend. Because every month you're spending money. So the idea is, let's say your bills are 10K a month or your business expenses are 10K a month. Let's say 8K a month. But you make 15K a month, let's just say. You bring in 10, borrow 8, spend the 8 on your expenses. But now you're investing 10K a month as a business and you're creating 120K a year of investment as a treasury. Now your business has all that money sitting there that you can also borrow from. Or as an individual, you could do it as well. We find more businesses because businesses have bigger amounts to play with. But we also do this with 9 to 5 people, anybody. People do it with $300 a month. People do it with $3,000. People do it with 30,000. So this is the same exact idea.
Although what you're really looking for is 5x leverage, it's just too hard to do it. Unless you're like MicroStrategy and you can take out unliquidable cheap institutional margin. And so there you have it.
So we do it on Aave, aave.com, aave.com. That's where your loan comes from, where you leverage. Aave's has $40 billion. Last bull run, it had $100 billion inside of it and it's growing very fast and it will continue to grow. Chase uses Aave. Huge banks around the world use Aave. So it's it's one of the safer crypto decentralized platforms. Again, can't guarantee anything with anything, but it's one of it's has what's called the Lindy effect. What that means is things that have been around a certain amount of time are more likely to be around longer. So Aave has been around since like 2017 doing this. So and it was called ETHLend before. So again, it's been around almost 10 years, more likely to be around for the next 10 years than something that just pops up today.
To 5x, a logical take, and you can't beat logic. The fact is, Bitcoin fundamentals are actually stronger than ever before, where the world recognizes Bitcoin, and it has been this unfollowable, unhackable, unchanged technology ever since its creation. TikTok next block. The hash rate is at all-time highs. We have ETFs, options markets, and the options actually do a lot to stabilize the price. 2025 is year one, with the first pro-Bitcoin president coming into office.
So this is big. What's possibly going to happen is, again, who knows if it actually happens, but if Donald Trump decides to say we're creating a strategic Bitcoin reserve for the country, then that means other countries are going to also have to do that, and there's already countries preempting it and saying we're going to do this before the US does it, so we benefit because once the US starts pouring money in, our investment now will grow. So again, non-financial advice, but this is very, very possible.
As the price has broke all-time highs and it
But also politics already, they're saying the current administration is going to sell a lot of that Bitcoin that we already have. So it may tank the price right now. Who knows? Again, that's why dollar cost averaging is the best. You do not know what's going to happen. You just got to put money in and as often as possible. That's why we dollar cost average every day. You deposit your bill money and your dollar cost averaging as much as you're spending every month as a business or an individual. Get as much Bitcoin as possible. Imagine investing as much as you spend every year. There's no how much more Bitcoin can you buy if you're buying as much as you're spending?
is in price discovery mode. The fact is, Bitcoin is actually one of the hardest things to buy and hold. No leverage, no day trading, no shortcuts. Don't get fancy, 4+ year time horizon. You can't see it nor touch it, yet it requires unwavering conviction.
This is where I tend to disagree with people that say this. Just buy it and never think about it. Even in 4 years, sometimes that's tough for people, right? Like if you buy something and you need money, like let's say you bought Bitcoin when it was 5,000 and now we're up, it's $100,000. So you bought one back then, but now you need a car. So you have no other way for paying for that car. What do? You just walk or you sell 25,000, 30,000 of that Bitcoin to buy the car, or at least enough for the down payment, something, right? This is where I rather borrow. I rather borrow off of it because borrow is tax free and I still get to keep the Bitcoin. The problem with right now is if you buy Bitcoin a certain way, the only way you can do that is by giving it to somebody and hoping they give it back. Right? So think about this. If I say, okay, I'll give you a loan on your Bitcoin. Give me the Bitcoin and I'll give you $30,000. Bitcoin's $100,000. If you never pay me back the 30K, I keep the 100,000, right? That's good. But then let's say next year Bitcoin's 200,000, 300,000, and you still haven't paid me back. Now you come back 4 years later, Bitcoin is 500,000, and you're like, here, I have the 30K for you. You may be like, you know what? Keep your 30K. I'm good. Right? I don't, of course, there's contracts and all that, but I don't trust that. That's why I like decentralized finance, where it's all in the code. And because I was a developer, I know how to look at the code and see it does what it said it's going to do, and there's no way to change it. So that's what the blockchain allows, Ethereum allows.
It's the Hall of Mirrors. The trick is to just keep going straight. Don't get lost. See you on the other side.